Okay, soldiers, Jerome Powell and the Fed are in the middle of a two-day meeting right now. They're deciding on various issues, one of which is whether to raise rates. Now, as soldiers of finance, we're going to be in a position to prosper whether he raises rates or not. Now, the likelihood is that Jerome Powell is going to raise the interest rate again. The speculation is whether it will be a 75 basis point hike or 100 or a full percentage point, in other words. Now, either way, we need to look at two specific assets that are going to be impacted by this, but in such a way that's going to give soldiers of finance one hell of an advantage.
Okay. All right.
All right, so there's a lot of, wringing of hands and gnashing of teeth out there. One economist said, this is really moving into restrictive monetary policy territory. We will be moving into no man's land, said one economist. We actually haven't tightened policy to fight inflation since the early 1980s, and that's true. Okay, so we're not really in no man's land if we've done it before, right? But that's the kind of hyperbole you can expect from the mainstream media. They need to sell paper, so the doom boom is always something that they're going to genuflect toward. But see, we're not going to do that here. We're going to look at the situations for what they are, be adults, and understand that, reality throws us challenges, and it's up to us to convert those challenges into opportunities. So that's the only speculation. It's not if he's going to raise rates, but how much he's going to raise rates by. Now, we all know that at this point in the game, we all know that when he does that, it will have an effect on the mortgage rates. Now, if you look here, and we'll take a look at the 30-year fixed mortgage rate, and you might say, well, why are you looking at the 30-year? Well, because my personal strategy has always been to get the 30-year mortgage, because sure, you can pay it off in 15 if you want to, but you have more flexibility, and typically you're going to have increased cash flow, because if you spread that payment out over 30 years, it's going to be less. Now, some people say, hey, I want to pay off my home. Hey, look, if that's your strategy, go for it. The reason why I am not personally predilected toward paying off real estate is because mortgage money is some of the cheapest money out there. And I know the rates are going up, but if you look at the chart here, then you'll see that in the 80s, the Paul Volcker era, you'll see that rates were much higher than they are now. So we are still at historic lows in terms of the last roughly 50 years. So comparatively speaking, now may be a good time to buy a house or a piece of property. I want you to also notice on this chart that the grayed out or shaded areas correspond with a recession. Now, we went back on a previous video and showed you how each of these shaded areas conform to the 2 consecutive quarters or more of negative GDP, gross domestic product. So we had to have that 2 to begin with. And then in eras like 2008, 2009, of course, stretched on for a little bit longer than that. But you'll notice that here we have September 15, 2022 is the last date on our chart here. You'll notice that they don't have that shaded out, even though we've gone through 2 consecutive quarters of negative growth and maybe looking at a third. You'll also want to pay attention to the fact that that definition of a recession was coined in 1974, and they even went all the way back and redefined those periods prior to that using that 2 consecutive quarters of negative growth definition. Okay, and as you can see from this chart, this is emblematic of how they like that definition so much. The recession definition of 2 consecutive quarters or more of negative GDP growth, it was coined in 74, and they went all the way back, retroactively applied it prior to that period. Now, this is emblematic. This is exactly why You cannot trust this regime because
clearly lying.
They lie about things they don't even need to lie about. It's just an addiction at this point, but you got to know where to look, because if you don't understand this, then you may be at risk when you're doing your due diligence of not having all of the information. So even though they're not counting it as a recession here, we're definitely in one based on over 70 years of their definitions. Okay, so what are the assets that are going to I'm not going to say do well, but these two assets in particular, as interest rates rise, they're going to put us in a position to take a serious look at assets in these categories because they're going to be specific advantages. Let's start out with real estate. And you might say, well, hey, Tyrone, look, you just showed us how the mortgage rate is headed in a northerly direction. I certainly did. But as mortgage rates increase, we're going to see in many markets, we're going to see a corresponding decrease in prices for properties in order to balance everything out. Now, important note about the real estate market. Number one, it is hyper local, which means, okay, let's take a market that is not hyper local, a true national global market, the stock market. So you go out there on the Dow 30 and you take a look at, I think Coca-Cola is still on the Dow Jones Industrial Average. You take a look at that and you say, I want to buy, I've got a guy in Sterling, Virginia on the East Coast, and I've got a lady in Los Angeles, California. Okay, let's say it's 1:30 p.m. Eastern time, so it's 4 hours later out on the west. It's 4 hours earlier rather out on the West Coast. So the market's open, everybody's up, and let's just say these two people, one in Sterling, Virginia, one in Los Angeles, California, decide to pick up the phone at the same time or get on the internet at the same time. They place an order to buy a share of Coca-Cola. Guess what? All things being equal, they're going to pay the exact same price for that because it is a global market. Okay. Now, not so with real estate. Let's take our same two individuals. Young lady goes to buy a house in Los Angeles, California. Gentleman goes to buy a house in Sterling, Virginia. They're probably going to be two different layouts. Definitely going to be two different school districts. They're going to have so many variables involved that those prices are going to be different. Guaranteed. So when you hear Case-Shiller Index and that kind of thing, rest assured that when you talk about real estate from a national perspective, you got to drill down much further than that to get an accurate picture of what's really going on. Okay. All right. So real estate, you go out there, you purchase some because prices in your area or the area you're interested in are falling. So maybe you want to invest in some income producing real estate. Maybe you want to, I don't know, create a data center or some sort of YouTube hotel where folk can come and do their studio thing, a corporate kitchen. I'm naming these things because you need to understand that there are aspects of rental real estate that are beyond just renting to folk, families, and individuals who need a place to live. There are aspects beyond just, the traditional office complex and that sort of thing. So you go out there and you do that. And yes, let's say that, we're a couple of months down the road here. Interest rates have caused the housing market to slow down. Interest rates have caused the small development, corporate development, or commercial development space to slow down. So what are people going to do? We're going to realize a glut of properties on the market, and we're going to see a decrease in prices. Again, area specific. So when we see that, we're going to get somewhat of a break on the price. Now, here's where it gets interesting. If we can get a break on the price, even if we have to pay an interest rate that's higher than what we would have paid 2, 3, 4 years ago, when interest rates come back down, and we can look at our chart again and we see that they do moderate, when they hit these troughs, that is an opportune time for you to bring the cost of money down, to refinance the mortgage on that property and realize more cash flow because you've been able to bring that interest rate down. Okay. So inevitably, at some point, at what point, I don't know. But inevitably, if we look at the chart, we've seen a roller coaster ride of interest rates. Okay. Are they going to get up to 13% like they did, or damn near 20% like they did in the Paul Volcker days? I don't know. Okay. I can't sit here and definitively state whether or not that will happen. But I do know that if someone's out there trying to sell property, they're going to have it's going to be just prohibitively expensive for most individuals and small businesses to acquire. And even if a business is flush with money, they're going to say, no, I'm not purchasing that at a high purchase price and a high interest rate. I'm never going to be able to recoup the money, okay, out of that investment. It's just not going to work. So market forces will take hold. So I want you to also think about this. Real estate is boring, okay? But it is lucrative. Now, as we've discussed plenty of times before, the assets that the different asset classes perform different functions, okay? They're like tools in a toolbox. They perform different functions. Real estate will give you tax advantages. It will appreciate over time, again, depending on variables like where it is located. And in addition to that, you can derive income from it. So you've got three advantages there. And when you look into the tax advantages associated with real estate, they are myriad, okay? It's not just one or two, there's several. That's why you got to make a CPA a part of your team. That way you can rest assured that you're doing everything legally and that you are getting everything you're entitled to from the tax code. All right, guys, the next asset I want to look at that is going to be in a position to help us out if Powell, in fact, raises rates is our old friend gold. Now, let's talk about the function of gold. Gold is not meant to perform like, let's say, Apple stock or Amazon stock or Berkshire Hathaway stock. Gold does not pay you an income. However, gold is an asset, okay? I had a friend say to me a couple of weeks ago, gold's not doing anything. It's actually going down, which, as we can tell from the chart, gold is indeed going down. But there's a reason why gold is going down. The reason it's, then this chart is back through October 2021. The reason why gold is on a downward spiral is because Powell is raising rates. And as a hedge against inflation, gold is meant to preserve your purchasing power over time. Rob McEwen, chairman and CEO of McEwen Mining, puts this in a nice little timely and topical perspective in terms of what gold does.
What would you say to somebody who doesn't understand gold, that maybe it's still a good investment today?
I think you're looking at preserving the purchasing power of your wealth. And just today I was out for a walk and we were having a conversation, and the idea came up when the iPhone came out, gold was around $700.
Yes.
And today the iPhone's around $1,500, and that's where gold is. And it has far more features.
iPhone to gold ratio has stayed relatively flat.
That's right.
Yeah.
So you're able to continue to buy, and you're actually buying a better product because there's more services on the iPhone of today than when it first came out. But gold kept that purchasing power, whereas the value of your dollar has gone down significantly.
Okay, so now that we have that out of the way, understand also that most of the central banks own some gold, okay? Except Canada. For some strange reason, they listened to the United States a while back, said, we should all sell all our gold. We should just sell the gold. And Canada stupidly listened. Now, they don't have any gold. And the United States has not sold its gold. Okay, all the other countries, the central banks have been buying. So the fact that gold is down because interest rates are rising. If interest rates rise, then that's designed at least to quell inflation. So if inflation is not increasing as rapidly as it has been, then gold is going to react to that. We gave the analogy a while back of gold being the lighthouse and the dollar being the ship, okay, on a rocky sea. So the lighthouse stays firm, attached to solid ground, and when the dollar is up here and is strong and is, interest rates are rising like now, then gold appears to be cheaper in relation to the dollar. When the dollar rather comes down here and it's weaker and interest rates are lower, okay, and inflation has more of an opportunity to take hold, then gold appears more expensive in relation to the dollar. But gold never fluctuates, okay? It's the dollar or whatever currency gold is pegged to, or whatever other commodity gold is pegged to that fluctuates. And McEwen's example of that, I'll give you one even better. We've given it on the channel before with regard to how the a Roman aristocrat could take an ounce of gold, purchase a fine tailored suit, a pair of sandals, and a custom-made belt, okay? And today, you can take an ounce of gold, which is roughly, somewhere in the neighborhood of $1,700, whatever it was on the chart, and go out and buy a custom-made suit, nice pair of shoes. And I'm going to tell you, ladies, and some of you guys, a good suit right about now is going to run you about $800 to $1,000. And when I say a good suit, I mean one that you can go to your best friend's wedding in, you can go to your wedding in, you can go to someone else's funeral in, and you can go to your funeral in. A suit that's going to be well designed and stand the test of time. It's going to be about $1,000. You're going to look at about $400 $400 to $500 for a pair of Bruno Magli, good pair of men's shoes, okay, that can be repurposed over time. You're going to keep them forever. And I don't know, I don't wear Gucci belts, but I hear they're expensive, so that should make up the remainder of it, right?
Gucci gang, Gucci gang, Gucci gang, Gucci gang, Gucci gang, Gucci gang.
Okay, so gold and real estate, we've shown how they are poised to present an opportunity for acquisition as rates rise. Now, there are other ways to go about this, especially with real estate. Warren Buffett is a big fan of investing in real estate investment trust. Sam Zell, he's another one that is a real estate investor, bar none, real estate magnate. He has several real estate investment trust. So that's another way to get this thing done. If you don't have the resources right now to go out and go whole hog on a building of some sort, study the real estate investment trust, okay? Now, I've told you before, I'm not a big fan of paper gold, simply because, there's some speculation as to whether or not it's there. So another way to get that done is through mining companies, okay? Investing in mining companies. They're majors, they're minors. You got to do your due diligence, see if it works for you. But those are my thoughts on how we as soldiers of finance can do our research, do our due diligence, and look, we need to win whatever happens. Raise rates, Powell. Go ahead, do it. We don't care. Raise them. We'll be able to take advantage of that. And if he does it assertively enough, we're going to see inflation come down. It's going to free up more money for us to go out there and purchase assets. Okay, you're done with this video. Go on over and watch this one. It's about how society is crumbling. There are several signs that indicate it, but there are things that we as soldiers of finance need to do in order to remain on the path to financial independence or maintain whatever financial independence we already have. And we can do that even though society is crumbling. Watch the video, guys. I'll talk to you soon.